Hi, my name is Phil Cioppa. I'm the host of the nationally syndicated radio program, The Phil Cioppa Show. And today we're going to speak for a moment about the different kinds of life insurance that exist in the United States. There are basically four different kinds. The first is whole life insurance. The second is universal life insurance. The third is variable universal life insurance. And the fourth is term insurance. Now, what are the differences? First of all, whole life, universal life, and variable universal life are what we refer to as cash policies. In other words, the premium you're paying in, a certain amount of that premium is paying for your insurance protection, and the rest of that premium is being put into some type of interest-bearing account. Whole life insurance usually pays the best interest. However, it also costs the most. So $100,000 of whole life is going to cost you a great deal more than $100,000 of universal life, or even on the other end of the spectrum, $100,000 of term life. In whole life, the company is paying you interest and dividends when it can. With universal life insurance, it's paying you dividends and interest if it can. But there is a minimum guarantee of interest that you're going to get on both the universal policy and the whole life policy. Usually whole life is a little bit higher guarantee because of the cost of the insurance, and the universal life I've seen as low as 1%, but it is 1% on the money that you're putting in there. With variable universal life, you're taking the risk because that policy, albeit a cash policy, the buildup, or in this case, the losing of money, is based upon whether or not you have chosen the correct funds to underline that policy. What do I mean by that? You can put in your money, any mutual fund, any exchange traded fund, any stock or bond that you want, but you're taking the responsibility of doing that. It's something that you have to accept the risk for. So variable universal life is something that has tremendous cash potential, but again, unlike whole life, unlike universal life, you're taking the risk with variable universal life. And then, of course, there is term insurance. Term insurance, unfortunately, is touted as the answer by a lot of financial advisors that do not know, unfortunately, what it is that they are talking about. Universal life has its place. It is insurance that, as it signifies, is placed into force for a certain period of time. However, after that, there is nothing. You have to either apply for term insurance again, or prior to the end of that term, you have to try to convert it into the one of the other three cash policies, whole life, universal life, and variable universal life, of which I spoke about earlier. Now, term does have its place. All four insurance types have their place, but you have to determine with the help of a professional what is best for you and what your needs are. Because if you want to have some cash savings, you're not going to put into term. And if you only want a death benefit and are not worried about saving any cash in insurance, you're obviously only going to want to go to term. So you need to determine, you need to understand the difference, and you need to speak with an insurance professional about ascertaining that which is the best for you. Thank you very much.